Cash is king. That could be our mantra as we go through chapter 9. The focus of this chapter is on the statement of cash flow, and we are looking at two primary questions. How is a statement of cash flow prepared? And how is that statement of cash flow interpreted? Let's begin with a general understanding of what a statement of cash flow is. Our statement of cash flow is the third of our three major financial statements, and it summarizes the sources and uses of funds during a specified fiscal period. The other thing it does, which is unique, is that it reconciles to the cash balance that appears on the balance sheet at the end of the same fiscal period. Recall in previous chapters where we discussed the other two financial statements, we looked first at the income statement, and we determined that in addition to the fundamentals that it should have who, what, and when identified in the heading, the name of the company, the name of the report, and the date, the income statement, of course, tells us the financial performance over a specified period. And so this is what happened for this company over the last 2 years, 2000X2 and 2000X3. They generated sales of 2 million in 1 year, 2.7 million in the subsequent year. Cost of goods sold changed from 1,200 to 1,700, which resulted in profits of 800, gross profit of 800 and $1,000 in each of those 2 years. And of course, from your reading and analysis so far, there are so many questions that you could ask, such as, was there a change in the revenue mix, assuming they're selling more than one product? Did they lower prices? And so on and so forth. The other section of the income statement is where we show the operating expenses, the selling expenses, the administrative expenses, and the general expenses, referred to in shorthand as SG&A. But they are operating expenses, and you can see the amount for the first year that we have shown and the second year. Again, you can ask so many questions about the operating expenses, questions such as, did they lay off anyone? Did they hire more individuals? Did they cut back on bonuses? Did they increase bonuses? Anything that would be related to the operating expenses would be fair game as far as questions to ask to better understand why their SG&A rose from $590,000 to $690,000. We have depreciation, what method of depreciation is being used, and such a question, of course, should be readily answered in the notes to the financials. So just because I pose a particular question doesn't mean I am going to be asking the client necessarily. It is simply a question that I would pose to better understand what I am looking at. Same thing for interest expense. Is it a fixed interest rate that they have? Did they take on more debt? So on and so forth. And of course, we then get the operating profit before taxes, which is taking these operating expenses and subtracting from the gross profit. We come to the third and final section of the income statement, which is where we will show any gain or losses from activities that are not primary activities of the business. So in this case, they sold in 2000 X3 fixed assets with the book value of 30,000, and it was sold at a gain of 10,000. So we know they sold it for $40,000. Again, this kind of detail would be in the notes to the financial statements. And we then have the income before taxes. We subtract the taxes. Of course, the corporation does not have any control over their tax rate, but they can certainly manage how they report income in order to minimize their tax obligation. The result of all of this is that they have a net income of 130,000 in 2000 X2, and that improved to 230,000 in 2000 X3. Recall, we made a distinction between profit and profitability. So just because your profit increased doesn't mean that you are more profitable. We would want to measure this profit in relationship to your sales, for example, and see if there is a higher percentage. And then we can say that you were more profitable. The other balance sheet that was discussed in Chapter 7 was the balance sheet. And whereas the income statement gave us the performance over a period of time, the balance sheet gives us the financial position at a specific point in time. So on this particular date, December 31st, 20X2, what were the assets? What were the liabilities? What was the equity? Same thing for 20X3. And so we show first in the balance sheet the current assets. These are the assets, as you know by now, are expected to be either used up or converted into cash within the next 12 months or the operating cycle, whichever of those two is longer. So these are the assets that should be used to pay the current liabilities. Hence, you understand why you calculated in Chapter 8 ratios such as the current ratio or the acid test ratio. The other group of assets would be your fixed or non-current assets. These are the assets that are expected to be on the balance sheet for more than one fiscal period. And you see here they have $300,000 worth of fixed assets at the end of 20X2, and it increased to 500,000 at the end of 20X3. Total assets in both years. We then move over to the liability side, and there we see our current liabilities. And in this case, we have just two, actually one for 20X2 and two for 20X3. But these liabilities should be paid from the current assets. So these are the obligations that are expected to be paid within the next 12 months or operating cycle, whichever of those two is longer. Then we have our long-term or non-current liabilities, and these are the ones that are expected to be paid over a period exceeding 1 year. And here you see they have $180,000 in each of those 2 years. And then we have the equity, the owner's equity, capital stock. They started out with $270,000, and we would of course add the retained earnings. So the retained earnings from 20X2 would be added here to get us to 400, and then we would take the profit for 20X3, add that to the ending balance for 20X2, and it should take us to 20X3. We will come back to these as we need to going forward. So those were the financial statements that we discussed in previous chapters, specifically chapter 6 and chapter 7. So why then do we need a statement of cash flow? Well, over time, analysts became disenchanted with the fixation on the bottom line, which is the income statement, because they realized that the income statement was giving you information that was accurate, but it wasn't necessarily good for decision making. Specifically, just because you show a profit doesn't mean you have cash. And so there are limitations to those two financial statements that require the banking industry, Wells Fargo specifically, to initiate a statement of cash flow. We will get into a little bit of the history in chapter 10. For now, let's answer the question, why do we need a statement of cash flow? So the income statement and the balance sheet, as I said, are important, but they have limitations. They do not measure and report funds coming from different sources or funds being used for different purposes. We simply see the items, assets, liability, equity, but it doesn't give us a picture of the actual use of funds and the source of funds. Here's another way of thinking about that point. Cash paid for goods sold could not be directly obtained, let's say, from the income statement unless we were using the cash method. So we would want to know that, not just cost of goods sold. Another example would be cash paid for building and equipment, not just current book value that we can get from the balance sheet. What about cash received from the sale of a long-term asset? That will be useful to know, not just the gain or the loss that resulted from the sale. Or cash received from bank loans, not just the amount that is currently owed. And finally, cash collected from the sale, not just the total sales that we can get from the income statement. So bottom line, there are limitations. And so we need another major financial statement that can provide us with additional relevant information. Now, we're talking about the statement of cash flow. And so a logical question would be, well, why don't we just look at the cash account? Well, first of all, most businesses would not want to give you access to their cash account. They'll show you the balance in their cash account, but they don't want to be showing you the deposits and the disbursements that occurred in a particular period. So that's one reason. The other thing is that the statement of cash flow is actually broader than what you can find in the cash account. Before you think that I'm speaking heresy, let me illustrate. Let's take two simple transactions, and you will hopefully see the difference between what you can see in the cash account versus what you would be able to see or derive from the statement of cash flow properly prepared. Let's say on February 2nd, we had this transaction. Started my business with $10,000 in cash. That's one transaction. And by now, you know how to record that. We would have just to remind everyone, we would have, from the perspective of my business, we would have a get of $10,000. So that will be an asset going up. And we would have a give of $10,000 to me, the owner. So the equity would go up. So we have a get for 10 and we have a give for 10. Then on the 12th, we had another transaction, purchased $5,000 of delivery for a delivery truck. And I made a down payment of $2,000 on behalf of the business and financed the balance, the remaining $3,000 with a bank loan. So of course, here we would have a get of $5,000, which would increase my delivery truck, which is a fixed asset. There will be a give of 2,000, which would decrease my cash. And then I would have another give, which is a promise to repay the bank $3,000. Well, let's see what happens in the cash account. In the cash account, what you would see is, of course, that we started with zero, because when I started my business, there was nothing in the business cash account. Then I deposited 10,000 on February 2nd. Then I withdrew $2,000 to make a down payment on the delivery truck. And so my balance is 10,000 minus 2,000 equals 8,000. Accurate, but incomplete in terms of the funding that occurred for this particular business. Still not making sense? Let me show you how the cash flow would report this information. So we're looking at source of funds, which would be where did your money come from, and uses of funds, where did your funds go? This is easy, right? Source of funds, we had 10,000 that came from the owner, $10,000. But look at this. We are saying that the $3,000 provided as a loan from the bank is also a source of funds because the bank funded the purchase of the truck, the delivery truck. Now, it could have been deposited into the bank account and then written to pay the seller of the delivery truck, or it could have gone directly from the bank to the seller of the delivery truck. In any case, the bank funded the $3,000. And so my total source of funds, which as you're beginning to see is broader than just cash receipts, is $13,000. Let's look at the use of funds. Well, we can tell what we did, right? We purchased a truck. Notice the total amount was not that we purchased, that we used was 5,000, even though we only made a deposit of 2. We are saying that we actually used $5,000 worth of funding. And so the source of funds would be 13, the use of fund would be 5, and so we're left with a net change of 8. Notice that this 8,000 matches the 8,000 that I show here, but you get a bigger picture in the statement of cash flow than you would just looking at the cash account, right? Because this does not tell you that we actually funded a $5,000 purchase. You look at this and it seems we only funded 2,000. So the point of this is that the statement of cash flow gives you a broader perspective. It probably should be titled Statement of Funds Flow, funds coming in, funds going out, instead of the statement of cash flow. But we won't fight that battle today. We will go with the title as is and simply try to understand the concept. And so the question then is, how do I identify outflows? Because you saw in my simple example that we had inflows, which would be source of funds, and we had outflows, which would be uses of funds. So here's your general statement. Whenever you have a give, sorry, in this case, we're looking at the outflows first. Whenever you have a get, this means that you had to have outflow in order to have what you receive, right? So if I get a car, for example, that is increasing my asset, but that's a funding that I would have had to give. So whenever an asset increases, then we can assume that there was a decrease in cash. Again, what we're doing here is we are using changes in other assets and liability accounts to determine the impact on the cash account. Let me say that again. We are using changes in assets and liability and equity accounts to determine what happened to the cash account. So the broad principle is whenever you have a get, it means that you would have had to give cash, and so that would be an outflow. Here are some general guidelines then. Uses of funds result from a get, such as increase in assets. So we got the delivery truck, our assets went up. Or in this example, inventory increased by $66,000. That would be a use of funds because the asset, the inventory increased. Then we have furniture increased by $102,000. That would be an example of another resulting outflow because in order to fund this increase in asset, we would have had to give or use our funding. On the liability and equity side, it would be the opposite. So whereas increases in assets would represent outflows, decreases in liability and equity would be outflows. So here's an example. Interest payable decreased by $12,000. If you think about it, if the payable went down, it means that we would have given or used funds to pay it down. Same thing here, capital stock decreased by $22,000. For it to go down, we'd have had to give the owner. So that would be a use of funds or an outflow. Let's take the other side of the coin, which would be inflows. Remember I told you that outflows were caused by a get? Well, an inflow is caused by a give. If I were to give something, then I should get funding or get cash, and so that would be my inflow. So we're looking here at what would be transactions or items that would cause inflow or result in inflows. Notice sources, we're talking about inflow, so sources of funds. So inflow and sources of funds, same concept. And they can result from a give, such as decrease in assets. For example, if accounts receivable decreased by $33,000, customer owed you, let's say they owed you $60,000 and it went down by $35,000, it means that you received, right? So if we see a decrease in an asset, we can assume then that would be an increase in our cash. Another example, building decreases by $50,000. So we may have sold the building. That would cause an increase in our cash. On the other side of the balance sheet, liability and equity would be the opposite. So whereas decrease in assets would represent sources of funds, increases in liability and equity would be sources. For example, accounts payable increased by $44,000. Why would that be a source of fund? Because we would have acquired something and the supplier funded it for us, and so that would be a source of funds. Another example, capital stock increased by $75,000. If the owner were to invest an additional $75,000, the equity would go up, and so we would assume, unless we had different information, that that was a source of fund or funding for the business. So big picture, inflows caused by give. So if you remember how to identify a give, then you can tell that you're looking at an inflow, and a give will always result whenever there is a decrease in an asset or an increase in a liability or equity. And a get would result if you have an increase in assets and a decrease in liability and equity. You will hear me say this over and over, so hopefully it will eventually make sense. So now we need to look at the statement of cash flow and ask, how do you prepare this report? Well, there are 3 sections to the statement of cash flow. These 3 sections summarize the sources and uses of funds within each of those sections or subsections, if you will. One of those is operating activities. You will hear me refer to it as OA, operating activities. And this section captures the inflow and outflows resulting from the operation of the business, selling inventory, providing the service, collecting on those receivables, paying those suppliers. All of those types of transactions result in inflows and outflows, and they will be captured in the operating activities section of the statement of cash flow. So that's section 1. The second section is called investing activities, or IA for short. At least that's my abbreviation. And here we are looking at inflows and outflows that result from the sale and purchase of fixed assets. So let me back up here for a second, because you can see that we're walking through the balance sheet. So this section is going to capture operating activities. So it's going to capture sales, which affect your receivables, which affect your payables, which affect your inventory. So basically, current assets and current liabilities are going to be the current items affecting the operating activities. The investing activities will be affected primarily by changes in your fixed assets. So you can see that we are working through the financial statements. The third and final section of the statement of cash flow is the financing activity section. And this one captures changes in the balance sheet that result from external funding, either from, say, a bank or some other lending institution, as well as the owner. So notice that we're not including accounts payable in here, because that would already have been captured in the operating activity section. But if you have external funding, a bank loan or a finance company, whatever the external lending source is, those items, along with funding or use of funds related to the owner or owners of the business, will be captured in the third and final section. So we will therefore have 3 sections in the statement of cash flow. Excuse me. There are 2 approaches that are used when preparing the statement of cash flow. One is called the indirect method, and the other is called the direct or direct method. I will save the explanation or the definition until we actually get to the preparation of the statement of cash flow. So here you would have the same requirement: the name of the company, which is your who; the what, which is the name of the report, statement of cash flow; and the when, which is the date. Notice that it's dated similar to the income statement, because it's capturing activities over a period. So in this case, we would be capturing, let's say, the cash inflow and outflow for the year. And so you're going to have a subtotal resulting from operating activities, a subtotal resulting from investing activities, and a subtotal resulting from financing activities. The sum of these 3, sometimes it will be negative, sometimes it will be positive, but the sum of these 3 will give us what is called the net increase or decrease in cash. We will then add the beginning balance of cash that we have on the balance sheet, and it should equal the ending balance of cash and equivalents on the balance sheet. So when I told you that the statement of cash flow reconciles to the cash and equivalent balances on the balance sheet, that is what I was referring to. So we have the big picture. Now let's dive in and look at a detailed preparation of the statement of cash flow. Realize that the specifics that go into each will be dependent on the type of business and how the financial statements are prepared, but the general principle will remain the same. So we're going to be using this income statement for these 2 years, and we need the balance sheet. In order to prepare a statement of cash flow, you would need at least a balance sheet and an income statement for the related period. So we have 2 years for the income statement and 2 years for the balance sheet. So let's go into the statement of cash flow, starting with the operating activities section. So we are going to be focusing on operating activities, and we're going to be using what is called the indirect method. Now, the indirect method is called such because it doesn't show you numbers that would directly appear in the cash account. In other words, when I show you the numbers that are here, you would not be able to go into the cash account and directly obtain those numbers. You add all the cash, for example, it won't give you, because we're showing the net result of these activities. So the indirect method begins with a summary number, which is the net income or net loss for the given period. So we're focusing on the statement of cash flow for 20X3. So we start with the net income, in this case, for that year. So notice that the first line in the indirect method will always be your profit or loss for that particular year. So this number is the summary, right? The net of the revenue and the expenses. So we're literally taking the result of all of these by using the bottom line, which is the net income of $230,000. And then we ask ourselves, is this actual cash that the company had for 20X3? And we answer that by making adjustments as needed. We're looking for any possible non-cash item that we reported as part of our income statement. I highlighted the two that are relevant here. One of those is, of course, depreciation. You know by now that depreciation is a non-cash item. It's an expense, right? It's an estimate of the value of an asset that has been used up, but it's not an actual cash disbursement. So we had deducted it when we were calculating profit, accrual-based profit, and so we're going to add it back to get closer to the actual cash profit of the firm. The other thing we're going to do here, and if we had things like bad debt expense, that will be a non-cash, we would add that back as well. But depreciation is usually the most popular non-cash item that needs to be added back. And then we have here the sale of the gain actually on the sale of the fixed asset. So this is not the total cash that was received. This was the gain. So it was added in here. And so we are going to subtract it. Again, we're trying to get to the actual cash profit for the period. So this is saying that when we take out the non-cash items, we have $260,000 in the operating activity section of our statement of cash flow. That's not our final number because we now need to account for the balance sheet, the changes in the assets, specifically current assets and current liabilities on the balance sheet. But again, you're beginning to see, hopefully, the link that exists among these three financial statements. So we continue from where we left off. We had our $260,000 that we did by taking the net income, adding back the depreciation, deducting the gain, and so we landed at 260. Now we look at these current assets. You could take them one line at a time. 150 went up to 155 went up to 255, so that's $100,000 increase. 95 went up to 195, that's $100,000. You could take it line by line, or as I have done here, I added these two current assets from 20x2, compared it with this total from 20x3, and the overall was an increase in our current assets of 200,000. Since that is an increase in an asset, it means that I used funds, and so we are going to take that increase and deduct it. Again, the assets increased. How did we have this get? By giving or using, and so that's an outflow. And then we go to the current liabilities, because remember, the current assets and the current liabilities, along with the other operating activities in the income statement, are what we use in the operating activity section. And so you take the change in the current liabilities. Notice we're not looking at this, even though it's a current liability, because it's external funding. So 220 went up to 270. That's an increase in the liability. So that's a source of funding. And so we add. So 260 subtract 200 plus 50 lands us at a positive $110,000. And so that is our net cash provided by operating activities. If it were a negative number, it would be net cash used in operating activities. So it's a positive, therefore we are, of course, happy with that. Notice that if it were a rapidly growing company in the early phases of the life cycle, it's possible that this would be negative because they would probably have huge increases in their current assets, which of course would be an outflow. And even though they may have increases in current liabilities, it may not be as large. And so this could be a negative. Or they could have started out with a loss because they are starting up the business, and you would therefore end with net cash used in operating activities for that particular year. So pay attention to the stage of the life cycle that your client is in, because that will influence how you interpret this particular number. But the general interpretation is that it's a positive. So their operating activities provided cash, as opposed to their operating activities ending up with the net usage of cash, right? They had a net provision for the year. So we're finished with the first of the three sections of the statement of cash flow. Let's move over now to the second section. We're looking at investing activities, and the focus here is on fixed assets. Did we have any inflow from fixed assets? Did we have any outflow resulting from fixed assets? And the answer is yes to both. So we had a proceeds from the sale of the fixed assets. Recall that they made a $10,000 gain on $30,000 worth of fixed assets. So the total inflow is 40,000. Notice also that by backing out the 10,000 earlier in the operating activities, we end up not double counting because this 40 is the 30 plus the 10. And so if we had not adjusted for the gain in the operating activities, we would have been double counting. And if you say, okay, well, why not just leave the 10 and use 30 here? Well, that would not be an accurate representation of the transaction because the proceeds, the inflow from the sale was not 30, it was 40,000. And so we have to show the accurate number here. And then, of course, the proceeds from the sale of fixed assets is 270. And if you're paying attention, and I hope you are, you should be questioning, how did I get 270 if I'm using the change in the fixed assets? Because you look here, it says 300,000. Fixed assets went up by 200,000 to 500. So why do I have 270 and not 200? Well, let's do a little bit of accounting and see if we can figure out what actually happened with our fixed assets. So we know that we started out with $300,000 at the beginning of 20X3. So we take that 300. What happened during the year? Well, we sold $30,000 of those assets, and we depreciated the assets. Recall from the income statement, we had depreciation of 40,000. So based on those transactions or events, this is what the fixed assets should total, 230. But it's not, it's 500. So the actual purchase of fixed assets was the 230 subtracting from the 500. So there was actually $270,000 worth of fixed assets purchased during the year. And so we take the 40 plus the 270, which is a negative, and we end up with a net negative of $230,000. If I did not mention this before, let me take this opportunity to state that in the statement of cash flow, each section, each of the three sections gives you its own subtotal. So this is the subtotal for the operating activities. This is the subtotal for the investing activities. At the very end, we will take the 110 plus the negative 230 and whatever the financing activity section shows us to come up with our overall total. So it's not a running total. We get a subtotal for each of the three sections, which means then we move on to the third and final section of the statement of cash flow. We're looking here now at the financing activities. And so we're asking, what were the amounts derived from external sources, either a lender or the owner? And that will determine what happened in the financing activities section. And so we have the line of credit went from 0 to 50. So that's an inflow, right, of 50,000. And we also had cash dividends paid of 30. And you should be saying, how did I know that? Because it wasn't told to us. Again, our detective work will show us exactly what happened. Recall that at the beginning of 20X3, we had $400,000 of total equity. Then we had $230,000 of profit for that year. So the balance should be $630,000. However, it is 600. And so it means then that the firm paid out $30,000 in the form of dividends. Good news, if this were a more detailed financial statement, they would most likely have a retained earnings section, and it would have given us that information more readily. but I want you to at least appreciate that we can use deductive reasoning to arrive at the information that we do need. So the key point here is that the dividends represent an outflow. And so from the investing activities, we see a negative 230, and that's usually the case. Your investing activities section will normally have a net outflow, whereas your operating activity should be a net inflow. In fact, it should be sufficient to take care of the needs in the other two sections. In this case, we have a positive, which is a cash provided by. We have a use here, and we end up with a small but positive source of funding in the financing activity section. So we have 1, 2, and 3. We have 3 sections now. And so we can put together the net change in our cash. So you take the 110, subtract the 230, add the 20, that gives you a net change in cash of 100,000, and it's a decrease. What that also is telling me is we were able to determine why the cash went down by 100,000. It went from 250 in 20X2 to 150 in 20X3. That's a $100,000 decrease. And now we know why. They had cash provided by operations, they had cash used in the investing, and they had a small funding provided by the financing activities section. And so we take the beginning cash of 250, add the negative 100, and it reconciles to the 150 that is reported in the balance sheet. So you can see the link there and the reconciliation. That's the indirect method. The other method is the direct method, and I will make this as simple as I possibly can. When you are preparing a statement of cash flow using the direct method, the only section that will be different is the operating activity section. The investing activity section will look the same. The financing activity section will look the same. The only section that will change is the operating activity section. So before I show you how I arrived at these numbers, I want you to appreciate that you're looking at the direct method. And secondly, I would like to let you know that it's referred to as the direct method because it's as though we are taking these numbers directly from the cash account of the business. What do I mean? Well, I'm showing here cash received from customers of 2,600, really 2.6 million. You understand that it's in thousands, but I'm just reading the numbers as they're written. So I have cash received from customers of 2,600. Well, what I'm suggesting is that if we were to go through the cash account of this business and add all the cash receipts from customers, it would total 2,600. So it's referred to as the direct method because it's as though we are directly pulling the numbers from the cash account. Or you could say that it's a direct link to the cash account. So whereas under the indirect, the numbers didn't have a direct match in the cash account, in this case, they should. So this 2,600, if we went through their cash account, we should be able to add all the deposits during the year, rather tedious, but we would be able to come up with the 2,600. So it's as though we're taking it directly from the cash account. Same thing for the cash paid to suppliers. 1,750 or $1.75 million. Total disbursements directly linked to the cash account. Then we have cash paid for operating expenses, 690, and we have cash paid for interest and taxes. I combine the two, and the total is 50. So notice that this number matches the same number that we had when we prepared the indirect method. And that is how it should be. Both methods should give you the same result, but the approach that is used will be different. So let me show you now how I arrived at the numbers. First of all, how did I get cash received from customers of 2,600? Well, I started by looking at how much was owed to us by customers at the beginning of the year. And then I added what we sold to them coming from the income statement, right? So it's possible that I could have collected $2,850,000 during the year. Did I collect that? No. How do I know? Because $255,000 of receivables are still being reported at the end of 20X3 in the balance sheet. You see how these three financial statements are interrelated. This is coming from the balance sheet. This is coming from the income statement. This is coming from the balance sheet. And now we're going to be reporting this amount in the statement of cash flow. So that's how we arrive at the cash received from customers. And it's exactly what it says. During the year, how much money did we get from our customers? And this is telling us we got a total of $2,600,000. This could be a combination of credit sales and cash sales, but that's a total cash. The other calculation is for cash paid to suppliers. Now, this one requires a two-step process. Step one, we need to calculate how much was paid for inventory, or how much, inventory we purchased on credit. So we need to know that first before we can figure out how much we actually paid to suppliers. To do that, we take the cost of goods sold from the income statement, because this is inventory that we used, right? We sold it during the year. So we take that and we said, okay, well, is that how much we purchased during the year? Well, the answer is no, because we had $95,000 already sitting there in inventory. So we wouldn't have needed to purchase $1.7 million during the year. So subtract that, brings us down to $1,605,000. Well, is that what we purchased? No, because we have an additional $195,000 sitting in inventory. So we add the ending balance, and this is the amount that we purchased on credit. Now we move to step two and we say, well, how much did we actually pay to suppliers? We know how much we bought on credit, but how much did we actually pay? It could be this amount, but most likely it's not. And we know that because they have accounts payable that is still outstanding. But we take this as our starting number, and we add the beginning balance, because we're saying maybe we paid the amount that we bought during the year plus what we owed from the previous year. So we could have paid $2,020,000, but we didn't. We know we didn't because we still owe $270,000 to our suppliers. So we subtract that and we end up with $1,750,000, which is what you see here. Now, why did I not have to go through those fancy calculations for these? Because there were no balance sheet references to operating expenses, no prepaid expenses or accrued expenses. So there was no adjustment to be made to the income statement amount. Same thing here. No changes to the cash paid for interest, because there was no interest payable at the beginning or at the end. So it is what they showed us. And of course, the same thing is true for the taxes. We did not see any prepaid taxes or accrued taxes on the balance sheet. So whatever number appeared in the balance sheet is the number that we would use. So again, the direct method, the only thing that will be different is the first section. And it starts with cash received from customers as opposed to the indirect method that would begin with the net income or net loss reported on the income statement. So once you have completed the operating activity section using the direct method, you would take the same numbers that you saw in the investing activities and financing activities section that I showed you when we used the indirect method. There is no difference. Now, not every single transaction is going to get captured in the statement of cash flow because there are some transactions that do not involve any cash at all. For example, if you accept a non-cash asset to replace an existing receivable, let's say, for example, someone owed you X amount of dollars, and in lieu of cash, they gave you a piece of land. That would be a non-cash transaction and would not get reflected in the statement of cash flow. Okay. Another example, let's say you had an accounts payable and you had it converted to a note payable. It would shift from being, say, on the current assets to long-term, but it would be a non-cash transaction, and so it would not get reported in the statement of cash flow. However, these two examples, if they existed, they would have appeared at the bottom of the statement of cash flow to indicate material non-cash transactions, if in fact they are. Finally, there are non-cash items that you saw that we did include in the statement of cash flow. And so I highlighted those with a different color. So you know about the depreciation, you know about things like the allowance for doubtful account, if you increase or decrease it. Those are non-cash, but of course, those are reported in the statement of cash flow and they are added back or subtracted, as the case might be, depending on how they were first treated in the income statement. So let me end with the second major section of our discussion, which is how to interpret or question the different sections of the statement of cash flow. First section was the operating activity. You saw the results that were there. What I did was I went back and calculated the numbers for 20x2, and I did this by assuming that 20x2 was the first year. So this is the profit from that year, add back the depreciation, and then you notice, remember they had $250,000 of current assets. So I assume that if this is the first year, then it would have been zero. So it increased by 250. So this would be an outflow. Same thing here, this would be an inflow. So the net cash provided by operating activities, 140, and it dropped to 110 in 20x3. Questions? This is not a complete list by any means, just suggesting some questions that could be asked. Are the changes in accounts receivable and inventory permanent or temporary? Hinting at the growth or lack thereof of the company. What stage of the life cycle is the company in? Has the company changed its credit or collection policies? And some of these are questions that you would have asked when you were doing your ratios. And so it's possible that we are repeating because we may not have had adequate response or clarity when we first asked the question. Another question could be, do most of the purchases and or sale occur towards the end of each fiscal year? Because that would impact the buildup of inventory if they're doing their purchases towards the end, or it would impact the decrease in inventory if most of their sales are occurring just before the end of the fiscal year when the financial statements are going to be prepared. So it would be good to know that. Do you anticipate a future decline in cash flow from operating activities? So we're wanting to know what they think the future holds as far as the cash from operating activities is concerned. It's declining. Is that an aberration or is that a trend? And so we would want to ask those kinds of questions. Again, I'm just giving you sample questions, not a complete or exhaustive list. Same thing for the investing activities section, questions that you could ask. Has the company reached its operating capacity, or are they going to be buying more fixed assets in order to reach that level? Why are they selling their fixed assets? Is it because of obsolescence? Is it because they are wanting to upgrade? Or did they have a cash need and they thought that this was one way to achieve that? What is it that, what is the amount of revenue produced to each major fixed asset? So again, your ratio analysis, where you do return on fixed assets, you could do it for each asset and see how that breaks down. Were disposed assets critical to the company's operations? Was the disposition of assets a one-time event, or is this the beginning of a pattern, a trend? What assets need to be replaced in the near future? When will these assets need to be replaced? Again, just some of the questions that one could ask relating to the investing activities section. The key takeaway should be that your question is relevant to the section of the statement of cash flow. Okay. Finally, the financing activities section. Possible questions include, what are the company's future borrowing needs? Maybe that's why you are involved in analyzing their financials. Does the business plan to borrow from the owner in the near future? Or will the owner be providing additional equity investment? Will the paying of dividends continue or increase? First year that we have, they paid no dividends. The second year they paid 30,000. Is that going to continue? Is that going to trend up? Is it going to stay flat? Those are questions that we would want to ask. What outside sources, of equity are available if the firm needed to tap into those sources? I hope you found this information to be helpful with you understanding the concepts. Please contact Oliver if you have any questions. He can be reached at 240-347-1541 or reach oliverswaby@gmail.com.